The timestamp matters. Between the final Asia close and the first European liquidity window, silver crossed $82.65. Not during a press release, not during a policy announcement. It happened while the screens were thin, spreads were wide, and risk desks were unattended. This was not a breakout in the way retail understands the word. It was a displacement. By the time North America woke up, the number had already been normalized, capped, and verbally dismissed. Commentary followed, explanations followed. But price discovery had already occurred, quietly, efficiently, and without permission. What matters is not that silver printed $82.65. What matters is how it printed, when it printed, and who was not there to stop it. Because in the same window, something else happened. 47% of visible liquidity vanished from the banking side of the book, not exited, not rotated, removed. This was not selling, it was withdrawal. Banks did not lose control of silver in that window. They stepped away from it. And when that happens, the market does exactly what it is structurally designed to do. It reprices towards scarcity. The timing is not random. We are now 53 hours from a settlement convergence window that has not occurred under these conditions before. Options, collateral rollovers, and physical delivery notices are stacking on the same calendar line without sufficient metal behind them. This is not a forecast. It is a scheduling fact. When liquidity disappears ahead of delivery stress, price is no longer the signal. Clearing behavior is, and clearing behavior changed overnight. During the same period, silver crossed $82.65. Interbank quoting depth collapsed, not volatility, depth. Spreads widened in a way that does not happen unless desks are instructed to stand down or cannot source inventory at known prices. That distinction matters. Standing down is a choice. Inability is a condition. Both produce the same surface effect. Neither is reversible on demand. The public narrative will focus on the number. They will debate whether $82 is real, sustainable, or exaggerated. That debate is already obsolete because the event did not occur at $80. It occurred when price moved freely without institutional resistance. That is the tell. Now the system is trying to rewind the tape before most participants realize the recording exists. This is why the next 53 hours are structurally unstable, not because silver is rising, but because the mechanisms designed to absorb demand have stopped absorbing. What you are watching is not a rally. It is a gap between paper confidence and physical obligation beginning to open, slowly, quietly, while most were asleep. And once that gap opens, it does not close with commentary. It closes with metal or with failure. That is where this begins. To understand what happened while price crossed $82.65, you have to stop thinking in terms of charts and start thinking in terms of absence. This was a ghost week, not officially labeled, not acknowledged on calendars, but fully visible to anyone watching clearing behavior instead of headlines. A ghost week occurs when derivative volume remains high, but balance sheet participation collapses. The contracts trade, the screens update, but the institutions that normally warehouse risk do not step in. Liquidity appears functional until it is tested, then it vanishes. That is exactly what occurred. As silver approached the upper boundary of the dealer tolerance band, quoting algorithms widened instead of tightening. That is backward behavior. In a healthy market, resistance increases near stress points. Here, resistance evaporated. Banks did not defend levels, they reduced exposure. The 47% figure matters because it represents committed balance sheet, not speculative flow. This was not hedge funds rotating out. This was primary dealers pulling back inventory-linked risk. Why? Because ghost weeks are not about price. They are about liability alignment. In the next 53 hours, multiple obligations converge. Options expiry, margin recalculation, collateral substitution, and physical delivery intent. Under normal conditions, these are staggered. This time, they are stacked. When banks see stacked obligations without sufficient deliverable supply, they do not wait for confirmation. They withdraw first. That withdrawal creates a liquidity vacuum. In a vacuum, price does not move smoothly. It jumps to the nearest available offer, regardless of narrative comfort. That is how silver printed $80.65 without a fight. Not because demand exploded, but because supply stepped aside. This is the most misunderstood aspect of market stress. People assume price spikes are caused by buying. In reality, the most violent moves occur when selling capacity disappears. And selling capacity is a balance sheet decision. Once a bank pulls its quotes, no amount of paper volume can recreate depth. Contracts can trade endlessly among non-delivering participants, but settlement risk accumulates underneath. That is what ghost weeks do. They concentrate risk into a narrow temporal window. Now add one more layer. Collateral quality is degrading at the same time. Treasury rehypothecation chains are stretched. Haircuts are rising. Silver-linked instruments are increasingly marked with internal risk weights that no longer assume frictionless delivery. When that happens, silver stops being treated as a price asset and starts being treated as a liability vector. That is when banks disengage. The public never sees the disengagement directly. They only see strange price behavior, sudden spikes, unexplained gaps, and frantic explanations after the fact. But inside the system, the signal is clear. If banks believed this move was temporary, they would fade it. They did not. If banks believed metal was available, they would lease it. They did not. If banks believed clearing would remain orderly, they would quote tighter spreads. They widened them. Those are not emotional reactions. They are procedural. And procedures do not change overnight unless the risk model has already broken. The $80.65 print was not a victory for bulls. It was a diagnostic. It showed what happens to silver pricing when institutional liquidity is removed for even a few hours. Now extend that condition across the next 53. That is the setup. Not excitement, not speculation. Structural exposure, meeting temporal compression. And ghost weeks never end quietly. Now we move away from screens, spreads, and settlement windows, and into the part of the market that does not respond to price signals in real time. Physical silver demand is not elastic. It does not pause because futures spike. It does not retreat because volatility increases. And it does not wait for commentary to settle. Industrial demand operates on obligation, not sentiment. Solar manufacturers do not hedge delivery risk with opinions. Defense contractors do not substitute inputs because a chart looks stretched. Electronics fabs do not delay throughput because banks pulled quotes overnight. They draw metal because production schedules require it. And those schedules are locked years in advance. Silver's physical demand profile has been in deficit for multiple consecutive years. That is not a forecast. It is already recorded. What has changed is not consumption. What has changed is inventory accessibility. Above-ground silver stocks that are unencumbered, not leased, not pledged, not swapped, have been draining quietly into long-term industrial channels. Once silver enters those channels, it does not return. Solar silver is vapor deposited, medical silver is embedded, military-grade silver is sealed. This is not bullion that reappears when price rises. It is consumed. That is why the market relies on paper flexibility to mask physical rigidity. As long as futures contracts can be rolled, offset, or cash settled, the system can pretend supply is responsive. But the physical layer has been diverging from that assumption. The inelasticity shows up first in procurement behavior. Fabricators are no longer buying hand to mouth. They are front-loading, locking supply, accepting higher prices in exchange for delivery certainty. That behavior does not register on futures charts immediately. It registers as inventory silence, fewer offers, longer lead times, tighter fabrication schedules. When banks pulled 47% of visible liquidity, they were not reacting to retail enthusiasm. They were reacting to procurement data. They can see what is being booked and for how far forward. And what they see is this. There's no surge capacity left. Mines cannot ramp meaningfully at these prices. Silver is primarily a byproduct. Copper, lead, and zinc production dictates flow. Higher silver prices do not instantly create more silver. They only reprice what already exists. Meanwhile, strategic stockpiles are no longer growing. They are being rationed. The market has crossed from a surplus management regime into an allocation regime. That shift is subtle until it is not. In an allocation regime, price stops functioning as a clearing mechanism and starts functioning as a filter. Who can pay? Who can wait? Who must accept delay? Industrial buyers choose certainty over cost. Financial players choose liquidity over exposure. That divergence is why paper liquidity collapses before physical shortages are acknowledged publicly. Banks know that once physical buyers refuse to release metal back into circulation, paper promises become directional risk. They step away early. The silver that matters now is not sitting in vaults with daily mark-to-market pricing. It is sitting inside supply chains that cannot unwind. This is why the $300 figure is not an emotional target. It is a stress threshold. At that level, substitution economics break. At that level, margin systems destabilize. At that level, paper holders must confront the difference between price exposure and delivery exposure. The panic does not begin because people want silver. It begins because institutions realize they cannot source it without repricing everything else around it. And that realization is already underway, quietly, in procurement offices, in inventory audits, in delivery schedules that no longer assume optionality. The physical market is not reacting to futures. The futures market is slowly discovering that the physical market has already moved on. This is where the distinction becomes unavoidable. Paper silver is not silver. It is a claim, conditional, deferrable, and governed by clearing tolerance. Physical silver is an obligation. The entire pricing complex depends on the assumption that these two remain functionally interchangeable. That assumption is now under strain. When silver crossed $82.65 during a liquidity vacuum, it exposed something the system works hard to obscure. Delivery risk is not evenly distributed. Most contracts are never intended to settle. They are designed to net, offset, expire quietly. That works only as long as a minority asks for metal. But when physical demand becomes inelastic and inventory becomes encumbered, delivery intent stops being noise and starts being signal. Clearinghouses do not panic publicly. They adjust parameters, margin changes, eligible collateral lists tighten, force majeure language is quietly reviewed. These are not dramatic moves. They are procedural. And procedures exist for one reason: to contain failure. When banks withdrew 47% of liquidity, they were not protecting price. They were protecting clearing exposure. Because every contract that stands for delivery during a constrained window increases systemic liability. The paper market can absorb volatility. It cannot absorb delivery mismatches at scale. This is where force majeure stops being theoretical, not because metal is gone, but because metal is spoken for. If a clearinghouse cannot guarantee timely delivery without destabilizing its members, it has two choices: reprioritize claims or suspend normal settlement. Both are failures of confidence. Neither requires a headline. Most participants assume that if delivery becomes difficult, cash settlement will resolve it. That assumption misunderstands the hierarchy. Cash settlement resolves individual contracts. It does not resolve trust. Once a market is known to cash settle under stress, its pricing authority erodes. Participants stop using it as a reference. They seek bilateral arrangements. Off-exchange premiums emerge. That is how price bifurcation begins. You already see early signs of this in spread behavior and lease rates. They are not screaming yet. They are whispering. But whispers inside clearing systems matter more than headlines outside them. The next 53 hours sit directly inside a delivery risk window where too many obligations converge and too little metal remains flexible. If nothing breaks, it will not be because the system was healthy. It will be because extraordinary measures were taken quietly. If something does break, it will not look like a crash. It will look like non-participation. No bids, no offers, only explanations after the fact. The public will ask why silver moved so fast, why prices jumped, why banks missed it. They will be asking the wrong question. The correct question is why banks stopped pretending paper and physical were the same thing. Because once that pretense ends, the market stops being a price discovery mechanism and becomes a rationing mechanism. And rationing is not negotiated on screens. It is enforced through access. That is the phase silver is entering now. Not loudly, not all at once, but structurally and irreversibly. This is the point where observers usually expect drama. They look for headlines, emergency meetings, visible interventions. That expectation misunderstands how systemic transitions actually occur. When markets move from distribution to rationing, the change is administrative, not theatrical. Access tightens first. The silver market is already there. Refiners are no longer quoting open-ended delivery windows. Fabricators are prioritizing contractual clients over spot buyers. Vault operators are revising withdrawal terms, not denying access, but slowing it. These are friction increases. Friction is how systems signal stress without admitting failure. At the same time, internal transfer pricing inside banks has shifted. Silver exposure is being marked not as a trading asset, but as a balance sheet encumbrance. That reclassification matters. Once an asset becomes an encumbrance, it is no longer deployed aggressively. It is conserved. This is why liquidity disappeared instead of fighting the $82.65 move. Conservation always precedes repricing. Now look forward, not at price, but at sequence. The next 53 hours compress three incompatible objectives into one window. First, paper markets must maintain the appearance of continuous pricing. Second, clearing systems must honor delivery commitments without destabilizing members. Third, physical supply chains must continue uninterrupted despite shrinking flexibility. Only two of those can be satisfied at once. Historically, the first is sacrificed last because it is the most visible. The second is protected at all costs because it is systemic. The third is quietly rationed. That is why premiums emerge off-screen, why delivery is delayed rather than denied, why explanations lag reality. The $300 level is not about enthusiasm or speculation. It is the approximate point where paper obligations, margin mechanics, and physical procurement costs collide. At that level, hedging breaks down, substitution fails, and accounting assumptions have to be rewritten. That is when panic begins, not among the public, but among institutions that thought exposure was contained. Panic, in this context, does not mean selling. It means scrambling for priority. Who gets metal first? Whose contract converts? Whose delivery is deferred? These decisions are not made democratically. They are made by proximity, balance sheet size, and strategic importance, which is why by the time the public sees confirmation, allocation has already occurred. The system does not collapse outward. It hollows inward. Liquidity drains. Access narrows. Confidence becomes conditional, and silver in that environment stops behaving like a commodity and starts behaving like a constraint. Constraints do not negotiate with narratives. They assert themselves through timing, through missed deliveries, through widened spreads, through sudden repricing that seems to come from nowhere. but it never comes from nowhere. It comes from weeks like this, where liquidity withdraws, obligations stack, and physical reality quietly takes control back from paper abstraction. This is not the end of the process. It is the midpoint. And what matters now is not what silver does next, but who is still able to touch it when the system finishes deciding. At this stage, the system shifts its language, not publicly, but internally. Silver is no longer discussed as an instrument. It is discussed as a vector of exposure, a vector of reputational risk, a vector of delivery failure. That linguistic shift only happens after a threshold has already been crossed. The threshold is confidence and optionality. For decades, the paper-silver market has operated on the assumption that obligations can always be deferred, rolled, or neutralized through cash equivalents. That assumption is now conditional. Conditional on time, conditional on participation, conditional on physical availability remaining abstract rather than enforced. The reason the 82.65 print matters is not that it was high. It is that it occurred without resistance during a window when resistance should have been maximal. That tells you the system is conserving for something ahead. When institutions conserve, it is because they expect demand they cannot refuse. That demand is delivery intent. Delivery intent does not have to be large in absolute terms. It only has to exceed available float during a compressed window. And right now, available float is thinner than at any point in modern silver trading. Metal is tied up in long-term industrial use. Leased metal is being recalled rather than rolled. Strategic holders are not lending. That leaves a narrow band of unencumbered supply supporting an outsized paper structure. The structure holds until it doesn't. What breaks it is not a run. It is prioritization. Clearinghouses will always protect themselves first. Member second, price discovery last. If forced to choose between honoring every contract and preserving systemic stability, they will choose stability. That choice does not require an announcement. It requires only a change in how rules are applied. Extended settlement, alternative compensation, revised eligibility. Each adjustment seems reasonable in isolation. Together, they redefine the market. By the time participants realize the definition has changed, the old assumptions no longer apply. This is where the Grayman mindset becomes relevant, not as ideology, but as posture. The system does not reward speed at this stage. It rewards position. Being visible attracts friction. Being early attracts scrutiny. Being quiet attracts continuity. Those who understand structural transitions do not react to price spikes. They watch access. Can metal still be moved without delay? Can delivery still be scheduled without negotiation? Can terms still be assumed? When the answer to those questions becomes, it depends, the transition is already advanced. Silver is approaching that point now, not because of fear, not because of excitement, but because too many obligations were built on the assumption that physical reality would remain optional. It never does. The next moves will feel disorderly to those watching charts. They will feel procedural to those watching clearing behavior. And when procedure overrides price, the market is no longer in control of its own narrative. It is being managed for survivability. That management phase does not reverse. It concludes. And what comes after is not a return to normal. It is a new definition of what silver is inside the system, and who is allowed to access it under stress. That definition is being written now. At this point, most participants misread what is happening. They assume the danger is volatility. They prepare for swings, pullbacks, reversals. Volatility is noise. The real signal is sequence. Silver did not move first in headlines. It moved first in access. Quotes thinned, leases shortened, delivery windows widened. Only after those conditions were in place did price begin to behave erratically. That order matters. Markets that fail do not fail from the outside in. They fail from the inside out. First, the system stops making promises it cannot easily keep. Then, it stops advertising that change. Only later does price reflect the new reality. We are now between the second and third stage. The next 53 hours are critical, not because something spectacular must happen, but because decisions made in this window will not be reversed later. Settlement choices made quietly now determine who carries exposure forward and who exits cleanly. Banks understand this, so do clearing members, so do industrial buyers. That is why activity looks strangely muted for something so consequential. No urgency on the surface, maximum urgency underneath. This is how capital behaves when it expects constraint. It moves early, slowly, and without explanation. Those still waiting for confirmation will get it, but not in a form they expect. Confirmation does not arrive as an announcement. It arrives as changed terms, higher margins, reduced size limits, longer settlement periods. Temporary accommodations that never quite roll back. Each one feels manageable. Together, they form a permanent shift. The silver market has reached the stage where continuity is preserved by restricting participation. Not everyone will be allowed to express demand equally. Not every claim will be honored identically. This is not corruption. It is hierarchy. Every stressed system reveals its hierarchy eventually. The public narrative will lag behind this reality by weeks, sometimes months. By the time it catches up, positioning is already locked. That is why the most important activity now is invisible. No headlines, no excitement, just quiet reclassification of what silver represents inside balance sheets and supply chains. When an asset stops being treated as interchangeable and starts being treated as strategic, it exits the realm of speculation. It becomes infrastructure. Infrastructure is defended, allocated, restricted, and infrastructure does not reprice smoothly. It jumps between regimes. That is why the next move will not feel linear. It will feel discontinuous, not because of panic, but because of delayed recognition. Silver is no longer waiting for permission to reprice. It is waiting for the system to finish deciding who absorbs the cost of its reality. That decision window is closing now, and once it closes, the market will behave as though the outcome was inevitable all along, because structurally, it was. The final phase is always the quietest, not because nothing is happening, but because what is happening no longer requires participation. By the time a system reaches this point, outcomes are managed, not debated. Silver is now being treated less like a market and more like a resource under constraint. That shift does not announce itself. It expresses itself through silence, fewer offers, longer waits, conditional access. Those who expect a dramatic ending misunderstand how structural transitions conclude. They do not end with collapse. They end with redefinition. The silver market will continue to exist. Prices will still print. Contracts will still trade. But the meaning of those prints will change. Price will no longer represent abundance. It will represent priority. Who pays? Who waits? Who is deferred? That is what the $82.65 event revealed while most were asleep. Not a number, but a condition. A brief moment where the market showed what silver looks like when institutional resistance is removed. The glimpse cannot be unseen. The next time resistance is withdrawn, it may not return at all. The $300 figure is not a prediction. It is a boundary where the old language fails completely. Above it, explanations stop working, models stop converging, and confidence stops being transferable. At that point, silver is no longer something you trade. It is something you manage around. The Grayman posture is not about fear or urgency, it is about alignment. Understanding that when systems change definitions, the loudest participants are rarely the safest. Continuity belongs to those who move without signaling, adjust without announcing, and understand that access, not price, is the true variable. What happened while you slept was not a spike. It was a test of how the system behaves when one of its assumptions is briefly suspended. The result was clear. Remove liquidity, and silver does not drift. It reasserts. The system is now trying to restore the assumption without admitting it was ever broken. Whether it succeeds or not is secondary. Because once a market reveals its true dependency, every participant adjusts accordingly, quietly, individually, irreversibly. And that is how structural change completes. Not with panic, but with acceptance, long before the public realizes the transition has already occurred.